Hello, this is Tushar Chande. Welcome to predicting the performance of the S&P 500 going into and out of the 2024 election. Our disclaimer is a gentle reminder that there is risk of loss in trading and that past performance is not necessarily indicative of future results. For the purposes of our analysis, we'll break down the time intervals into two chunks. The first is a 3-month period going into the November election, and the second is the 14-month period starting in November of the election year and ending in December of the following year. So this could be to the end of the first year of a new administration or the first year of the second term of a particular administration. And we look at 20 election cycles starting in 52 and ending in 2020. So this slide summarizes the cumulative performance in the August, September, October time period in the 3 months before an election. The vertical axis is the cumulative return, and these are the election cycles. And the average return was only 0.09%. So returns in the 3 months leading into the election were essentially flat. This slide summarizes the S&P 500 performance in the 14 months after an election. So the vertical axis is cumulative performance from November of the election year to December of the following year, and these are the election cycles. The key to note is the average return was about 11.5%, and about 67% of all intervals were positive. This slide summarizes the performance in the August, September, October 3-month block during election years and all years. And if you look at the average return, the standard deviation, or the percentage positive intervals, the performance during election years and all other years is essentially indistinguishable. This slide summarizes the performance over the 14-month interval starting in November and ending in the following December. We're comparing the average return and the average performance in such intervals starting in the election year or in any year, and essentially the performance is indistinguishable. So this slide summarizes my expectation for the S&P 500 going into the November election and coming out of it. I expect the market to be flat or down in the August-October interval, say -1% to +1%. In the 14 months after the election, I expect the market to be up double digits, say average to above average returns in the 12 to 21% range. So in summary, we found there was no meaningful difference in the performance of the 3-month interval going into an election or into November and the 14 months coming out of November between an election year and any other year. So the market clearly marches to the tune of its own drummer. This year we have two main variables: the potential election related volatility that occurs in every cycle, and layered onto that, the interest rate actions of the US Federal Reserve between now and the end of next year. So on average, we should expect performance that's similar to what's happened historically. And so it's best to expect volatility between, say, August of this year and January, February of next year, when we're in the heart of the pre-election and post-election period. Thank you very much for watching.